Welcome back to the morning show here on Arise News.
Joining us now is the Group Managing Director of Afrinvest West Africa, Mr. Ike Chioke, to discuss the investment bank's latest Nigerian Banking Report titled An Economic Agenda for a New Government. Welcome to the morning show.
Good morning, Rebecca.
Good morning, sir. Welcome to the morning show.
Yeah, let me start with, this annual banking report.
Thank you.
Last year, there was a lot of optimism in your report. You were talking about a recovery, a new recovery and all of that. And you said everything looked balanced. There's a lot of optimism. But this year, will you say that your prediction was right? Will you say that you were, correct in those predictions?
I think you recall last year that we're coming out of the recession of 2016. So on the rebound, we expected that with the introduction of the Economic Recovery and Growth Plan, coming in strongly, the implementation of that would then lead on to more momentum into 2018. So that was somewhat the case. We saw growth in the Q1 at about 2%. However, in Q2, it kind of tapered off to 1.5%, growth in GDP. The rest of the year, however, we're projecting a 2.1% growth. The only challenge with growth that at the levels where we have today is that it's below the inflation, below the rate of population growth. Population is growing around 2.83%. And so when you're still at the anemic levels of 2% growth, it's still not exciting. So that, as far as the report of last year is concerned, we have recovered and we have seen growth because out of 2016, we were in negative territory, which was the recession we experienced. But even though we're seeing growth, that growth isn't sufficient. Now, as we look forward into the future, we're not asking ourselves, what are the catalyzing things that the government can do to bring Nigeria back to that momentum of growth, in the high single digits like we used to have, earlier, about 4 or 5 years ago?
Yeah, we'll come to that, those catalytic issues or, growth areas. Now, in the course of the year, there have been reports, most recently, by interested observers, if you like, stakeholders in the Nigerian economy, HSBC Securities, the IMF, the World Bank, the Financial Times, the Economist, and the projections they've been making have been relatively negative. Even the HSBC Securities was saying President Buhari should not even bother to run for a second time, in office because his government has not shown a capacity to deal with the fault lines, the macroeconomic fault lines in the Nigerian economy. The standard response from government is to say they're talking rubbish. What do you think?
Well, we've sort of feel that they have sort of mixed up the politics of government with the economics of government. And if you look at it from the political angle, you then realize, okay, they don't want to take these reforms now because it might rebound negatively for them at the polls. But unfortunately, they missed an excellent opportunity to have taken reforms much earlier, either in 2016, when we were in the recession, or even in 2017. Now we're in 2018, we have urgent reforms all over. And it goes from oil and gas to power, to infrastructure, to, good governance, to things like making ourselves being more competitive. Even in agriculture, where we're seeing some progress, there's still need for reform. And then look at the entire security apparatus. And so when you look at the combination of all these issues across different sectors, small wonder that someone sitting outside Nigeria will say, wait a minute, these people seem like they're totally incapable of governing. But we feel that there's a chance to come back to the table. There's a chance to set the agenda again come 2019, because as a new government, assuming he comes back, he has a new government, he has now a fresh slate to kind of, introduce those reforms that the economy critically needs. If you were talking about NNPC earlier in this program, the oil and gas sector is one that, urgently needs serious reform. So we've been talking about the petroleum industry bill for the last 10 years. Can you imagine a decade debating a bill? So we don't have any fiscal regime that will allow a major oil company to make an investment. Now, if you're coming in to do any investment in any oil block that's going to run you hundreds of millions of dollars, you certainly want to know the kind of fiscal regime you're facing before you make that commitment. And because we've stood on the fence, essentially the oil industry has stood on the fence. And those are some of the difficulties that we experience as a result of doing nothing.
We're talking about this setting an agenda for the next government. I mean, in this period when, we're in a season of transition.
Correct.
What is the agenda you are setting? One, for the banking sector, and in other key areas that you focus on, human capital development, investments, and all of that. What kind of agenda should we be looking forward to in that report?
Our report is primarily based on the banking sector.
Okay.
But the banks are a toll gate, essentially, a catalyst to the economy. So if the economy does well, the banks do better.
Okay.
If the economy doesn't do well, the banks still come out doing okay. As a result, our report has shown, in 2017, we saw gross earnings go up to 4.6 trillion naira from about 3.9 trillion the year before. And total profit before tax around 850 billion for the industry, a good improvement, 42% from the previous year. Already in 2018, we can see profit before tax above 550 billion for the industry. So the momentum is growing, is good for the banks, even though for the rest of the economy, it may not be as good. But when you then think about what it is that can catalyze the economy, you then have to say, okay, can we do something in oil and gas? Certainly we can. We have a downstream sector that we continue to subsidize. At the 360 naira exchange rate, the amount of subsidy is about 842 billion naira. But if you actually use the government's exchange rate, which is 305, it rises to about 1.6 trillion naira of subsidy in 2018 alone. And here you are as a government looking for money to do urgent critical things in education and healthcare within the human capital development angle, or empower where you need to fund that sector, probably provide subsidy within power, because that is subsidizing production rather than subsidizing consumption in downstream petroleum. And you're struggling for resources, which has now led us to now go, borrowing across the world. We are now on the roadshow to do another Eurobond issue before the end of this year. $2.8 billion is the target, which has been approved for the year. And the government, some of the agencies you've talked about, the World Bank and the IMF, have said, look, your debt level is perhaps looking a bit more unsustainable because your revenue to debt service is a fraction. Your debt service to revenue at 67% on a real basis. It's scandalous. And those are some of the issues we are facing. So even if you go from power, if you go to oil and gas, if you go to agriculture, you go to security, we have, issues of security around the whole country that need to be looked at critically, because it's not everything that requires you to throw the army at them. A lot of things require you to have a conflict resolution structure to deal at the root causes of these issues before they then come into, people killing tens and hundreds of their fellow citizens every other day. And then if you look at even ways to make ourselves competitive, non-government areas where it's not really money that's the issue. How do we unlock the bottleneck in Apapa? How do we remove the non-tariff barriers to trade in this country?
Well, let's touch on the inflation rate. The Nigerian Consumer Price Index has risen to 11.28%, correct, recently, according to the National Bureau of Statistics. At this stage, what effect does this increase have on the equities market? And does this affect portfolio investors?
Yeah, portfolio investors have sort of taken a backseat to Nigeria, because some of the other actions we're taking at the macro level have not been beneficial. Remember, investors were watching as we decided to impose an $8 billion fine on MTN, followed by another $2 billion tax charge on MTN. So those are instances that investors begin to note, particularly international investors, who account for about 40 or 50% of our equity market.
Okay.
Now, closer to home, inflation is rising because we are seeing an uptick in food price inflation.
Okay.
Inflation has been going down mostly due to what they call a base effect, because it was higher in the previous years. As the change of inflation is reducing, the actual inflation number comes down. But in fact, for the average person, prices are higher than they were the year before. Now, what can we do about that? In this environment where you have politics, seeping into everything, it becomes difficult. Investors will look at opportunities on a single basis. They will not really look at the macro overall. A portfolio investor sitting in New York might say, okay, I need to do maybe in Nigeria 20% of my sub-Saharan African portfolio. But now they may be more discriminating and say, look, I'll come to Nigeria and look for specific stocks because I don't want to take too much of a risk given that all the issues are coming out as a result of the election coming in.
Well, I'd like to take you back to your earlier comment.
Yes.
You said the banks appear to be doing very well.
Correct.
Even if other sectors may not be doing well. Now, and this is a sore point, with average Nigerians. Every time when we see the annual reports of the banks are making so much money, the ordinary man looks around and he says, I mean, these people are making all the money.
Correct.
Where is this money? How does it trickle down to the ordinary person who is maybe involved in agriculture, in SME, entrepreneurship, and other parts? What is responsible for this disconnect? Where is the money coming from?
The money is simply coming
is there some witchcraft?
No, there's no witchcraft. No, there's no witchcraft. It's simply the opportunity of being a commercial bank. If you're in a system where the government is borrowing a lot, and you have a lot of depositors' money coming to you, at the very minimum, you can still lend the government money when you buy their T-bills. You understand? So the banks can take risk-free positions where they earn, a decent income. T-bills around 11, 12% today. It's a decent income on a tax-adjusted basis. Brings it about, 15, 16%. Now, would they want to do that rather than advance money to Arise Television and then have to be exposed to the risks of advertising revenue or other kind of sources of income? And then some banks might feel, actually, I'd rather stand on the sidelines because in an uncertain economy with a lot of policy issues that have not been resolved, particularly in the real sector, like we just talked about, then obviously advancing credit to the real sector becomes a challenge. So you see that they only do that credit when there are somewhat, appropriate structures like, CBN has set up a number of structures in the agri sector. But, banks, for the most part, if you go to take a facility from them, you're definitely north of 20%. And you have to ask yourself, what kind of business am I going to do that I can afford to pay interest in the 22 to 25% region? Hence, a lot of real businesses might say, you know what, perhaps this is not the time to grow. So the banks, in effect, are sitting on cash. Their capital adequacy ratio is rising. We saw an improvement where the top-tier banks are now about 23% capital adequacy ratio. The average for the industry is at 20%. And it tells you from the numbers that they are not deploying their cash as effectively as they could, just simply because they are retrenching and watching the economy and taking advantage of cheaper sources of income from the government itself.
Your report usually talks about vulnerabilities to growth potential. Going forward, in the light of the election, what are the vulnerabilities that you've been able to identify going forward?
Well, in the near term, I think the issues of security will remain paramount, and how we deal with that decisively, that's a critical one. The issues of food security is an important one because our population is growing at such a rate that we're not actually moving the agri sector in a way that it is mechanized, it has far more efficiency, and the yield per hectare is stronger and comparable to other comparable countries. The issues of healthcare and education are critical, because our commitment to those sectors is a fraction of what it should be. The United Nations recommends something like 26% of our budget should go to that sector. I think we're currently doing about 2 or 3% combined. So you have these, armies of, uneducated youth everywhere. We're an estimated 13 million children out of, primary school. So if you think about those are longer-term issues. But within the time frame of the election, what you then see is how the government manages to, run a free and fair election. The recent examples have not been as reassuring, what you've seen in, Ekiti State or maybe Osun State. But, with the whole national election coming in 2019, I think what, pundits and watchers will be concerned that, you maintain a polity that is free and fair, because otherwise there could be far more issues in terms of destabilizing.
How do all of this affect the banking sector? I mean, the banks make their money anyway, and they probably make more money during election time.
there's a lot of liquidity in the system during election time. And so there's a lot of money that could have been better invested in, purchasing higher yield investments that may be sitting in call accounts or current accounts because the owners of the money need to deploy it quickly. So that gives the banks an opportunity to earn extra income for themselves. For sure, that will come in. Plus a lot of, fees and fee income from, disbursements and charges. So that certainly will come in as a consequence for the banks.
Okay.
But when you look at the banking system in Nigeria, I mean, the effort in the past years has been, to develop that banking sector, make it international, make it stronger. Do you think we're anywhere there yet?
I think in terms of, we did a research, a survey on banking services. And while the feedback has been mixed, there's some people who say, look, some of these banks are not as good as I would like them to be. But if you actually compare the quality of banking services we get in Nigeria to international markets or to other comparable developing markets, we're actually running a fairly sophisticated system. The amount of banking that Nigerians are able to do on their mobile phones is quite superior to what you might see in the United States or in the UK for that matter. And so there's a lot of investment there. But what has not really caught up is how you get a lot of the unbanked and the underbanked into the system. I think that the challenge is, again, infrastructure, broadband infrastructure this time. Data is still fairly expensive in Nigeria, so a lot of people are tied to using what they call USSB banking, the star 901 or 737, those kind of structures that give you access to some, automated banking services on your phone, but it doesn't give you the full complement of services that if you could afford the data, you'd ordinarily would have. So there's an opportunity for the government to do more investments in broadband internet access across the country, and that will then improve technology availability, data, and consequentially banking services, and kind of take us to the next level.
How healthy are Nigerian banks in terms of liquidity ratios and in terms of the gap, very wide, obvious gap between Tier 1 and Tier 2 banks?
Yes, the momentum has always favored the Tier 1 banks. If you look at the overall revenue pot, they're at about 70% of the market. So 6 banks, which will be UBA, Access, Zenith, GTB, EcoBank, and First Bank, all in Tier 1, will take over 70% of the market share. And then the rest are in Tier 2. So you then see clearly that the profitability numbers are higher and richer at the Tier 1 level. Again, if you're a Tier 1 bank and you have a bigger balance sheet, you almost kind of cherry pick the kind of credits you want to do. So if a Dangote Cement wants to do, say, 500 billion, they may say the minimum amount we want to take from any syndicate member is 50 billion. Now, only the Tier 1s will have the capacity to join that club. If you're a smaller bank, your balance sheet may not allow you to lend more than 20 or 25 billion, in which case you're automatically not even included. And you're then left dealing with the weaker credits, which might then create risk losses for you down the road and create higher non-performing loans. And so when you look at the what you call the non-performing loan ratios, you see that generally speaking, the Tier 1s are better than the Tier 2. But there are still some problems among some Tier 1s who have, sort of an overhang of bad loans from previous years they have not digested.
Well, before we let you go, I mean, your annual report on the banking sector, I think it's something that is of interest to a wide category of Nigerians.
I think next week you guys will be presenting.
It's not, no, we don't sell it.
No, it's so expensive because, I mean, I tried to access it and I was being told, you have to pay like $700, you have to pay like 100,000, you have to pay like 250,000 to access a report. What is the interest? Is it for profit or you want to disseminate knowledge?
No, we're really in it for knowledge sharing. We're launching the report in
250,000. You are disseminating knowledge with 250,000 naira per copy.
Well, there's obviously the executive summary is free for everyone, and the executive summary gives a good overview. But when you're asking for 250,000, it probably means that you want to have access to all the Excel spreadsheets that are supporting the analysis, all the charts and the graph. And then, there's a cost of, human capacity that build a report over a 6-month period. So they do have to earn some income. But we always make the executive summary free for everyone, and we're available at any point in time to explain it. So there is the fact that as a business, we have to remain in business, you know.
Anyway, I'm just pulling your legs. Now, before you go,
thank you.
What will it take Tier 2 banks to bridge that gap, you know, with Tier 1 banks in terms of NPR and liquidity ratios?
There are some bright spots among the Tier 2 banks, no doubt about it. I mean, a good Tier 2 bank can remain really focused in its niche and manage its business with technology and do very well. There are sparkling examples in there, if I might name.
You want to name them?
I think FCMB has turned the corner from how it used to be run before. Very good ratios. We're seeing good numbers from Sterling Bank. We're seeing good numbers from Wema Bank. So clearly, there are people that can be focused in their niche and do exceedingly well. And sometimes, even as a business person, you find that you go to a Tier 1 bank, and they just don't have time for you. Because, you know, the numbers you're talking, you think 5 billion naira is a big number, they glaze over and want to go to sleep. So you might as well go to a place where your business is important. So there's enough capacity for banks, really, you know, when we look at it. So it depends on really what you're seeking for in any respect. But we think there's opportunity across the spectrum, both among the Tier 2 banks and the Tier 1 banks.
Well, thank you very much for coming to the morning show.
Thank you. It's my pleasure.
Thank you for your
insights.
Thank
you. Yes. It was a pleasure having you here. We'll take a short break now on the morning show. When we return, Arise News analyst Emmanuel Ifeni will join us with a review of some of the headlines on today's newspapers. Stay with us.